Many investors and financial advisors are fond of dividends and base their entire investment strategies on companies that pay out these dividends. However, it's time that we take a closer look at the reality of dividends and their impact on an investment's performance. The truth is, and I might be upsetting the dividend loving crowd here, but dividends do not add any extra value to your investments. I'm not saying you shouldn't invest in companies that pay dividends. I'm simply saying that those dividends add no extra value. I'm Mark Sabrin from TransCanada Wealth Management. Let's dig into it. What is a dividend? A dividend is a payment made by a company to its shareholders, usually in the form of cash or additional shares on a quarterly basis. Since payments are somewhat regular, many advisors position a dividend investment strategy like owning a rental property. Let's say that you own a rental property. As long as you have renters, you'll continue receiving regular payments, whether or not the value of the home goes up or down in value. When it comes to your investments, if you build out a portfolio made up of dividend paying stocks, you'll be receiving regular dividends, like rent, whether or not the portfolio increases or decreases in value. Don't get me wrong, this sounds very appealing. If your portfolio goes down in value, well, you're still receiving income from your dividend portfolio. And if your portfolio increases in value, you're taking advantage of appreciation and you're still receiving dividend income. However, in reality, no extra value is created by receiving a dividend. You're simply moving money from the left pocket into the right pocket. Let me explain. When a company pays out a dividend, the value of the company will decrease by the value of the dividend. For example, let's say we have company X and it's worth $1 million. And just to simplify this example, let's say they have no revenue and no assets. All they have is $1 million sitting in their bank account. If they decide to pay out a dividend of 5% or $50,000, they're going to have $950,000 left in their bank account. So the value of the company went down in value. As an owner of a dividend paying stock, this is where the rental property comparison falls apart. Suppose you own 10% or $100,000 of company X, and that company, as mentioned, pays out a 5% dividend. So in your case, you receive a payout of $5,000. Now, in this case, the value of your shares would drop to $95,000 and you would have $5,000 in cash from the dividend payment. So in total, you still have $100,000. No extra value is created by receiving the dividend. If you had reinvested the dividend of company X rather than taking it as cash, you would still have $100,000 worth of company X shares. Now, in both cases, whether you received the dividend as cash or if it was reinvested, you end up in the same situation where you still have $100,000. No extra value was created. Now, on the other hand, if you own a rental property that's worth $100,000 and you receive a rent payment of $5,000, well, that rent payment is going to have no impact on the value of the home. So you'll be $5,000 ahead at the end of the day. Hence, dividends do not equate to rental income. Our friends over at honestmath.com do a great job of illustrating this. We have stock A, which pays a high dividend, stock B, which pays a lower dividend, and stock C, which has no dividend at all. Now, like we just reviewed, whenever you receive a dividend, the value of the company or the stock goes down in value. So stock A will have less capital appreciation than stock B, and stock B will have less capital appreciation than stock C. But at the end of the day, all of these stocks will have the same net rate of return. So no extra value is created by receiving dividends. Another reason investors and advisors love dividends is the income they provide, especially in retirement. Despite how good it feels to receive a dividend, it will not make you any wealthier. There are more tax efficient ways to receive income in retirement. In keeping with our previous example, if you own $100,000 of company X and receive a $5,000 dividend, your shares will now be worth $95,000 and you will have $5,000 in cash. Alternatively, let's say that we have company Y, and company Y is the exact same business as company X, except it doesn't pay a dividend. Let's say that you needed $5,000. You could simply sell $5,000 worth of shares of company Y. And in this scenario, you would still have $95,000 of company Y and $5,000 in cash. So in both scenarios, you end up in the same position, dividend or not. However, if you own both of these companies in your non-registered account, company Y would be more tax efficient because withdrawing capital is taxed at a lesser rate than receiving dividend income. Additionally, selling shares allows you to withdraw the exact amount of money that you need. So let's say you only needed $3,000. Well, you could sell $3,000 worth of shares. Whereas if the dividend was $5,000, well, now you're having to pay tax on money that you didn't actually need. If you own the shares of Company X and Company Y in a registered account, such as a TFSA or RSP, then there is no difference because there is no taxes on dividends or capital withdrawals. In conclusion, there's nothing wrong with owning companies that pay out a dividend, but you have to understand that it's not like a rental property. The dividend itself is not creating any extra value because, as we reviewed, you're simply taking money out of your left pocket and putting it into your right pocket. The next time you hear an advisor prop up their dividend investment strategy, proceed with caution because they might be a salesperson and not a professional portfolio manager. I hope you enjoyed today's video. Hit that subscribe button and we'll see you next time.